Expect the unexpected. Well, I did not. Hello everyone, in today's episode, I will share 5 investing lessons that I learned the hard way in 2023. This year has been another interesting year for investors, with a lot of surprises. And along the way, I picked up some painful but timeless lessons and reminders that I can use in 2024 and beyond. So, if you are ready, let's do it. Number 1. Quality stocks outperform defensive stocks during periods of uncertainty. There are still plenty of uncertainty going around despite continued signs of market recovery in 2023. But one thing is clear: investors were rewarded by sticking with high-quality stocks rather than switching to defensive stocks which were undervalued and appeared to be cheap. During the bear market in 2022, defensive stocks like the utilities and consumer staples performed well, but over the full 2 years, high-quality stocks outperformed the defensive stocks with a wide margin. Another big challenge with trying to switch back and forth between high-quality stocks and defensive stocks during periods of uncertainty is that you need to get the right timing. But it has been proven time and time again that time in the market beats timing the market. It's way much easier to stick with high-quality stocks that you are familiar with. Number 2. Pay close attention to high-yield stocks. This year, the market took a nosedive affecting some dividend stocks, particularly those with high yields. Many investors were caught off guard when the real estate and utility stocks, which use a lot of debt but typically have the highest dividend yields, took a plunge as bond yield rose. These stocks suffered a double jeopardy as higher interest rates raised the cost of refinancing their debt, and at the same time, their yields suddenly didn't look attractive compared to bonds. Before investing on high-yield stocks, it is crucial that investors should know how much is the debt of the company, how easily they can manage that debt, and how sustainable their dividend payments are. For all of these, check out the company's financial health and examine its future growth. Number 3. Over-concentrated companies. Last March, the Silicon Valley Bank collapsed. Why? Because the bank only served a small group of customers, which is the technology companies in California. When the technology sector experienced a downturn, the companies and employees started withdrawing their deposits. This resulted in bank rundown, which was compounded by the fact that the bank's assets weren't as liquid as they should be. Its reliance on specific market ultimately led to the collapse of the bank. Other banks also became vulnerable due to the pressure facing the commercial real estate industry. While only few actually collapsed, their stock prices still reflect the risk of being dependent on a single region or industry. In summary, companies can be at risk when they are reliant on a single product, market, or a small group of customers. This doesn't mean that you should avoid such companies, but it is important to account for the risk when it comes to position sizing. Number 4. Great companies are those who continuously innovate and reinvent themselves. Take Apple as an example. It was once a struggling computer company, but was able to reinvent itself and became the largest consumer electronics company in the world. Back then, the mobile phone industry was dominated by Nokia, Motorola, Samsung, and BlackBerry. But endeavoring to think differently, Apple was able to launch a mobile phone of their own that became a household name. The performance of some of the world's most valuable companies this year, like Microsoft, Alphabet, Nvidia, Amazon, and Apple, is a great reminder that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price, as Warren Buffett said. These companies benefited from the growth of the AI industry. Yet, when these companies were founded, AI wasn't part of the plan. If you are invested in companies like these at a reasonable price, hold it for as long as they keep innovating. Number 5. Ignore the noise. I mean those market predictions. At the beginning of the year, many financial gurus and so-called Wall Street experts give their predictions regarding the performance of the market for the year, but are seldom close to the actual figures towards the end of the year. For example, in 2022, their targets for the S&P 500 ranges from 4,400 to 5,300, but the index ended the year at 3,839. That's 13% to 15% lower than their target range. Also this year, 2023, their target ranges from 3,400 to 4,500, but with 10 days left to go until the end of the year, the index is within 4,700. This does not mean that these financial gurus and professional analysts don't know the market. It simply means that the market is heavily dictated by unforeseen factors, making it very difficult to make a prediction. There you have it, folks. These are the 5 investing lessons that I learned the hard way. I did lose some investment as a result, but thanks God I was able to figure it out and make the necessary adjustment. Adios.